Governments love to claim they are working for your financial freedom. How true that is, of course, is debatable. They talk about stability, growth, and opportunity. But history tells a much darker story. For centuries, governments have used hidden financial mechanisms to keep the majority struggling while concentrating wealth and power at the top. These methods are not new. They are simply repackaged, renamed, and resold to each generation. The goal has always been the same: move wealth upward and keep the masses dependent on the system. The oldest and most familiar trick is inflation. When governments spend more than they collect in taxes, they face two options. They can raise taxes openly, or they can quietly reduce the value of the currency. Ancient Rome mastered this strategy. In the 3rd century, emperors lowered the silver content of the denarius to fund military expenses. The coins looked the same, but their value collapsed. Inflation surged, savings evaporated, and wages fell behind. It was a silent tax on the population. Today, the same tactic is used not by imperial mints, but by central banks. In the Middle Ages, the game continued through forced loans. Kings in England, France, and Spain pressured merchants and guilds to lend money to the crown. Refusal meant fines, confiscation, or worse. Repayment often came late, in devalued currency, or not at all. While governments financed wars and luxury, private capital was drained under the banner of patriotic duty. By the 17th century, debt itself became the system. With the creation of the Bank of England, borrowing from wealthy investors was institutionalized. Government bonds offered secure interest payments, but those payments were funded by taxes paid by ordinary people. The wealthy earned risk-free returns, while the lower classes bore the cost. Even today, lending money to governments is considered one of the safest investments in the world, backed by the labor of the public. In the modern era, budget deficits follow the same pattern. Borrowing is sold as development and prosperity. In reality, much of the money flows to defense contractors, large corporations, and financial institutions. When it's time to pay the bill, the burden falls on the public through inflation, higher taxes, or reduced social benefits. Profits rise to the top, while costs flow downward. The 2008 financial crisis exposed this clearly. Banks took reckless risks and nearly collapsed the global economy. Governments stepped in and rescued them using public funds. Losses were socialized, profits remained private, and the system became even more centralized. This was called stability. Pension systems operate under a similar illusion. People contribute for decades, believing their money is being saved. In reality, it is often spent immediately, replaced with promises that future generations will pay the bill. When populations age, the solution is predictable: lower benefits, raise the retirement age, or inflate away the value of payouts. Many readers are likely thinking of their own country right now. Modern tools like quantitative easing produce the same outcome. Trillions are created to stabilize markets. Asset prices rise. Stocks, real estate, and investments gain value. But those assets are owned primarily by the wealthy. For most people, the result is a higher cost of living and deeper inequality. Inflation and indirect taxes become hidden forms of taxation. Throughout history, the mechanism remains the same. Language hides reality. Inflation is framed as growth. Debt is sold as investment. Bailouts are labeled stability and reform. Complexity becomes camouflage. When people cannot see how wealth is transferred, they cannot resist it. The lesson is simple. These methods persist as long as people remain ignorant of economic history. Financial knowledge is resistance. When you understand the system, you are harder to exploit. History does not repeat itself exactly, but for those who fail to understand it, the outcome is always the same.